Hi, good morning. We are going to talk about certain credits that are available to a US taxpayer when he files his income tax return form 1040. This discussion is divided into three videos. In this video, we'll be talking about the nature, characteristics, the differences, and the basic premise over which these credits are based. In the next video, we are going to talk about the example from these two credits. For example, the child tax credit as a non-refundable credit, the additional child tax credit as a refundable credit, the requirements, the provisions that are required to be fulfilled by a taxpayer to avail those benefits. And in the third video, we are going to talk about the calculation aspects of these two credits. It requires a 10-step process to find out the actual amount. Now, talking about this video, it is divided into two parts. In the first part, we'll talk about a very simple concept, why these benefits are known as credits. And the next part, we'll talk about the nature, difference, and requirements. Now, why credit? It's simply because of the accounting process. What happens is, in any monetary transaction, there are two or more parties. So in our tax process, let's say there is one party is US government, which prepare its own books of account and has opened an account for the taxpayer. On the same side, there is a taxpayer who has prepared his own book of account and has opened an account for the US government where he records all the taxes paid and the liabilities accrued. Now let's say there is a $100 liability on the taxpayer. So what US government will do, it will debit the taxpayer account with $100. At the same time, the taxpayer will credit the US government account with $100 because he is liable to pay this amount to the government. When he actually pays this amount or discharges the liability due to any manner, he debits the US government account with $100. At the same time, the US government, because the payment is made, it, it credits the taxpayer's account with $100. And this is the step, this is the credit which we are actually talking about. So simply stating, when there is a tax due on the taxpayer, the US government debits the taxpayer account, and when there is a payment received from the taxpayer, the US government credits the taxpayer account. Resultantly, the liability of the taxpayer reduces. However, in the case of benefit, in the case of credits, there is no actual payment received from the taxpayer side. It is a kind of benefit that is provided by the US government to the taxpayer. And when the taxpayer uses or utilizes such credits in his Form 1040, it actually reduces down the tax liability of the taxpayer. And since the taxpayer's liability is reducing down, symbolically, it is assumed that US government has received that payment just symbolically. For the time being, let's say that the US government has received the payment, and therefore, since any receipt is actually credited in the US government's books of account, these benefits are termed as credit from a US government point of view. So whenever you think about or you get confused about why it is called as these benefits are called as credit, simply understand that because these benefits are reducing down the tax liability of the taxpayer, it is assumed to be paid by the taxpayer to the US government, and therefore symbolically US government has named these benefits as credits because anyhow any kind of payment received by the US government is credited in the party's account in the books of account of the US government. Now let's move on to the second part of the video where we are going to talk about the nature, the differences, and the concept of these two credits. We'll try to understand this concept with an example of sale and purchase transaction. Let's say you went to an Apple store and where you want to buy an iPhone, which costs you around $2,000. You'll be liable for this $2,000 only when you enter into a contract with the store, that is, you intend to buy and they are ready to sell it to you. So once you are liable for this, let's call it a gross payable amount for this $2,000, the store gives you a discount of $200. The first question is why you are getting the discount. Of course, this discount is reducing your liability, but have you actually made any payment? No, you have not. You are getting this discount maybe because you are fulfilling certain conditions of the Apple Store. Maybe you have went there to under a scheme or in a festival period, or you have filled such form and other conditions you are fulfilling, so that under a scheme they are giving you a $200 discount by their own accord. Notice that you have not made any actual payment. This is a benefit provided by the store from their own side. So this discount actually reduces down your liability to 218 to $1,800. Now, there can be a situation where you have a deposit or a past advance with the store already because you are an old customer, or you have a credit note from the store and of $100, So this $100, again, you are not making any actual payment right now. But because this $100 was paid to Apple Store previously due to some old transactions, this $100 will also reduce your net liability of $1,800. And then finally you make the final payment of $1,700. These two items of reduction of credit note or an advance or old deposit and a new payment will actually call as payments. And because of these payments, your final liability will come down to zero. Now you can see that both the items, first of discount and second of payments, both are actually reducing your liability to zero. But can you say that both the items are same? Just because they are reducing the liability, that does not mean that both the items are same. So now let's discuss the differences between the character and the nature of these two items. Let's take one by one. For example, first question is, does discount reduces your liability? Yes, it does. Does payment reduce your liability? Yes, it does. So at this point, both are same. What is the nature of discount? Is discount a payment from your side? Have you given some kind of cash or some kind of amount from your side? No. Discount is simply a benefit received by you because you have fulfilled certain conditions, right? But payment is not a benefit, it's actually a discharge of liability. There is an outflow of an asset from your side, and that asset is cash, is money, right? So, on nature aspect, both the items are different. Are there any conditions attached to avail the benefit of discount? Yes, there are conditions attached. Only if you fulfill those conditions, you will be eligible for that discount. However, in case of payment, there are no additional conditions. The basic premise can be that you have a liability to pay the amount because you are purchasing an item. That's why you have to make a payment. That's a quid pro quo. Because you are receiving something, you are going to pay and discharge of a liability. There can be a situation where you are actually making the payment without the liability as an advance payment or as a deposit. So basically, there is no additional conditions attached to payment. When does the discount arise? Can you get a discount without entering into a contract? No. Until and unless there is a gross liability on you to make a payment for a certain amount, you cannot avail the benefit of a discount. That is to say, you cannot say to the shopkeeper or the seller that, okay, I'm not going to buy anything, you just give me that discount amount in cash. No, you cannot say that. Only if when you enter into a transaction, you are liable for $2,000, then only on fulfillment of certain conditions, the seller is going to give you a discount of $200. So the discount is directly attached to entering into a transaction. But at the same time, you need not have any kind of liability to make the payment to the seller or to the shopkeeper. Sometimes you deposit certain amount with your nearby shopkeeper, which is near to your house, as an advance for the monthly transactions, right? Even you can make some extra payment over and above your liability towards the shopkeeper by mistake or towards some future transactions. So there is no limit. There is nothing, there is no base requirement for you to make a payment. Though practically it happens rarely, but no law states you or stops you from making some extra payment over and above your liability, or even if you don't have any liability. But because of normal business transactions, discounts can only be availed, can only be received when you have a gross liability towards some amount, right? Now, can the discount be in excess towards your gross liability or more than your gross liability? No, it cannot. That is absurd. You cannot tell the Apple Store that, okay, the iPhone costs $2,000, you give me a discount of $2,100. That's nonsense, right? But the payments can be in excess. We just discussed that even if you don't have any liability towards the payment or towards an amount, you can still make some extra payment to the shopkeeper. Nobody's stopping you from doing that, right? What is the maximum limit to avail the discount? Of course, the maximum limit of discount is fixed at your gross liability. What you can have a maximum discount of $2,000, right? You can have the item for free, but the shopkeeper is never going to give you the iPhone plus $100 from his own side, right? So there is a maximum limit to avail a discount, that is your gross liability. But again, there is no maximum limit for the payment. Even if your liability is of $2,000, you can still make a payment of $3,000, and then you can have a refund of $1,000 later, or you can have adjustment of $1,000 from from your future purchases, right? Then can there be cash refund? As simple as that, because the discount cannot be more than the gross liability. There cannot be a negative balance. You cannot have a cash refund. But at the same time, the payments can be more or can be even without the existence of any liability. Though there can be a situation where the refund arises from the seller to the buyer, right? What are the examples and tax for the same items? You can simply relate that all the features which we have discussed for discount, they exist in the case of non-refundable credit. We'll discuss about that in the next slide. And in India, the same item can be related to the rebate, the concept of rebate. In the payments, we can see that in US, see the table shows you the items or the terminologies used in US and in India. US are considered as payment, and that's why they have the same features which we discussed above for the payment topic. Now, taking this example further and now relating it directly to our discussion of non-refundable credit and the payments. First of all, whether the non-refundable credit reduces your liability? Yes, it does. Whether the payment reduces your liability? Yes, it does. What is the nature? The non-refundable credit have nothing to do with your payments or your asset. They are benefit provided by the US government. So these are benefit received on fulfillment of certain conditions. But the payment is a discharge of liability from your side. Actually, your asset, your cash, your money goes towards the discharge of this liability. Are there conditions attached? There definitely. For all non-refundable credits, there are conditions attached. Only when you fulfill those conditions, you are eligible to claim those benefit as credit in your 1040 form. But for payments, there are no condition attached. You have to clear off your liability. When does the benefit arise? Right? Only when you have a liability towards your gross tax amount. Until and unless you have a gross tax liability, you cannot claim any non-refundable credit as benefit. So for example, even though you have fulfilled certain conditions and you have, let's say, a child tax credit benefit of $2,000 and your gross tax liability is zero, you cannot ask from the government as $2,000 as a refund. Because child tax credit is a non-refundable credit, you can only take the benefit. You can only reduce that amount if you have a gross tax liability. If your gross tax liability is zero, your child tax credit availability will be zero, right? At the same time, for the payment, there need not be any kind of liability. Even if your gross tax liability or your net tax liability is zero, you can still have the advance payment made to the US government in the form of taxes withheld or your estimated tax which you pay or which you deposit with the government quarterly, right? Can it be in excess? Non-refundable credit cannot be in excess. We just discounts can be up to the maximum of your gross liability. Similarly, your non-refundable credits can be maximum up to your gross tax liability, not more than that. The payments can be up to any amount without any limiting factor to it. What is the maximum limit? Gross tax liability for the non-refundable credit. If your gross tax liability is $100, the maximum child tax credit you can take is $100, even though if you are eligible for $2,000. But in the case of payments, there is no limit. You can make any kind of payment, any higher payment than your liability, right? Is there a cash refund? Simply because the highest limit what you can claim as a non-refundable credit is your gross tax liability. There cannot be a negative balance, and hence there is no question of cash refund in the case of non-refundable credit. But in the case of payments, because the payments can be higher than your liability, obviously there is a concept of cash refund, because of the simple reason that a simple universal doctrine applies that nobody can have a wrongful gain. Whatever extra payment you have made to the seller, he does not owns it. He is liable, he is duty bound to give you back that refund, the refund of that extra payment. And therefore, and this principle is applied everywhere in any kind of law made everywhere. You can call it nobody can have a wrongful gain, or you can call it equitable justice. Any terminology, anything which you say, the simple concept is the seller cannot possess, cannot retain what he does not owns, right? So that's why there is a cash refund concept in the case of extra payments. But since there cannot be any extra non-refundable credit, there is no cash refund concept in the case of non-refundable credits. Now, there is a form 1040. It's a screenshot of a 1040 page 2. You can see that the page 2, right now we are seeing the two sections. The first one being tax and credits, and the second one being payments. You can see the line number 19 and 20 in tax and credits. The child tax credit And whatever is mentioned in amount 20 is actually talking about the total of non-refundable credit which a particular taxpayer is eligible for. Now you can see that in this section, which has a heading of tax and credit, you don't have mention of any refundable credit. It's only talking about non-refundable credits. But at the same time, if you look at the payment side, the payment section from line number 27 to 29 and line number 31, they talk about refundable credits. Now the question is why refundable credits are shown separately in payment section and not along with their counterparts, that is the non-refundable credits. Why? What are the basic reason behind keeping the refundable credits along with the payments? You can see line number 25 talks about the taxes withheld. Line number 26 talks about estimated tax payment. So they are actually talking about the payments from the taxpayer side. And we know that refundable credits are not actually payments. They are just the benefit received. But still, they are kept along with payments. And this is the concept we are going to talk about. What actually happened was that non-refundable credits had certain, definitely they were benefit received, but they had certain restrictions. For example, there was a maximum limit, there was no refund, and non-refundable credit only arises when you have a gross tax liability. So government actually wanted to promote certain more activities, and that's why what they did was they created a hybrid concept of refundable credits. What they did was they kept all the positive aspects of payments and non-refundable credit in this refundable credits and removed any drawbacks of non-refundable credit. You can see that does it reduce your liability refundable credit? It definitely reduces your liability without actual payments. You don't have to make any payment, but still the refundable credits will reduce your tax liability. Definitely, the nature is of benefit received because here you're not making actual payments. And definitely, there are conditions attached to it. Because you are not making any payments, they are the benefits provided by the government. The government attached some conditions. When a taxpayer fulfills some certain conditions, they become eligible for the refundable credits. Now, from here on, they combine the concept of payment into the credit to remove the drawbacks of non-refundable credit. Since we know non-refundable credit only arises when you have a gross tax liability, and the payments had an advantage that even if you don't have any liability, you can make the payments. Similarly happens with refundable credits. You need not have any gross tax liability or any net tax liability. If you are eligible for a refundable credit, you can claim that credit and any extra amount, and therefore it can be in excess to your gross tax liability or your net tax liability, and any extra amount will be allowed as a refund to you. So there is no limit to it. Of course, the limit is attached with the particular provision. For example, if additional child tax credit being a refundable credit is limited to $1,500 per eligible child. So if a taxpayer has one eligible child, the maximum amount he can take as is $1,500. And let's say he is eligible for $1,500 of a refundable credit and there is no tax liability, he'll be eligible for a $1,500 refund. So in that sense, there is no maximum limit attached to a refundable credit. And that's why we can say that where the first three aspects of the refundable credits are directly related to the characteristics of a non-refundable credit, the remaining aspects are directly related to the payments. And therefore, they are shown along with payments in Form 1040 because they will create a refund for the taxpayer, even though the taxpayer don't have any tax liability, right? And that's how we come to the conclusion of this video where we have talked about all the three aspects: payments, refundable credits, non-refundable credits, their characteristics, their features, their differences. And we have also talked about the doctrine and principle behind the refund concept. And we need to know more about the doctrine and principle as a professional because the provisions and law may differ, but the doctrines will remain the same. Certain equitable doctrines like law of equitable justice, law of quantum meruit, quid pro quo, all these things, etc. There are so many. All these apply to almost all the laws everywhere. Now, what was the importance? Let me share with you that as a student, I have been through an institute where you can see illustration on a screen. If you as a student can identify whether you know about the individual chapter, whether you know about the estate tax or not, right? If you can relate, if you can read this illustration, and this is from estate tax, right? And if you can even identify what is wrong with this illustration, As a US tax student, I was not aware about any US tax provision. I was very new to an institute. They claim to have 10 to 15 or 20 years of experience in US tax as the owner owns a firm under US tax. They claim to have so many EAs and EA solving sessions and the professionals. But I was always doubtful about the course and the quality of teaching they were providing. But being new to it, being a CA also, I was not able to raise a question over that. But once, after repetitive errors and the mistakes, once I reached to estate tax chapter and I saw this illustration, immediately I was able to identify a mistake in this illustration. And that was not because I knew the provisions of US tax, because I knew certain principle, certain doctrine of income tax that is applicable everywhere in the world. And since I got the idea, I got the hinge of idea that there can be something, some error. I did my own research. I referred to US publications and the tables, and I was able to find a concrete answer as to where the whole illustration was wrong. And I got the courage to write a whole, whole report where the teacher was wrong everywhere in his notes, in his teaching. I don't know how he created EAs and all, but I was able to question their EAs of a doubt solving team. I have proof of everything. And because of this, I was able to claim refund of 60,000 from that institute in India, right? And I will credit that not to my understanding of CA or not to my knowing of CA, EA or US tax provisions, but to understanding of my basic principle of tax. As a student, if you can identify where this illustration goes wrong, you need not have any idea. You don't need to know any kind of US tax provision or estate tax provision. Just a simple understanding of taxes will help you do that. So it's a challenge to you. If you can identify where this illustration is wrong, right? If you can do that, do comment and do reply back. And in case you like the video, you learn something new, do provide a feedback. It will be a motivation.